Well, okay, let's go and get started for the day. Thank you guys for joining us and coming out to our third session on how to raise angel funding. We've had two sessions previous to this. It's a 16-module session in which we're doing 4 modules in each session that we're doing right now. And so with that, we'll go through and, as you've seen before, we'll have a set of slides and then we'll stop and take your questions. You have a question box on the screen there, so you can just type those questions in as they come to you, and we'll answer them at the end. And if you'd like to discuss offline, just drop me an email, and I'll be glad to set up a time to talk with you by phone or in the coffee shop. Also, I will send out the recording. I'll push that to YouTube and send you a link, and also the slides as well. So the slides you see today, I'll send you this evening after we have the recording up on the site. So let's go ahead and kick off and talk about the follow-up. And so after you do the pitch, you know, most entrepreneurs think the pitch is the most important step. They're just trying to get the pitch perfect, and while we appreciate them putting a great effort into it, what I find is that in reality it's what happens after the pitch that determines if you get funding or not, and it's the follow-up that counts the most, and it probably gets the least amount of attention or effort from the entrepreneurs. And so the follow-up starts in the pitch itself. And by that I mean as you conclude the pitch, or as you conclude your discussion in the pitch with the investor, ask the investor if you can keep them informed of your progress with periodic updates. And then place the investor on your investor prospect list. Most investors will say yes. They don't mind hearing about updates. They're always curious as to how it's going to turn out, and they are very interested to keep track of how things are progressing. Even if they're not interested now, many investors become interested later after they see the traction and the momentum you're building in your company. But what we're going to do is create an investor prospect list. This is different from an investor list. If you already have investors, you're sending them information, financials, updates, etc., and that's specific to investors, but the investor prospect is a different thing. And so what you want to do is send them monthly, bi-monthly, or quarterly updates on your progress itself. So these are not very long emails. They are short 2 to 3 paragraph emails describing your progress. You talk about building the product, lead generation, how it's going with customers, forming the team, and the fundraise itself. Again, they're very short 2 to 3 paragraph emails, and while you may not have something to say on all of these topics, you want to focus on these main topics and not talk about how the market is growing or what a competitor is doing. Instead, you want to talk about what you are doing yourself. In other words, the investor wants to know what your execution is producing and what can you do, not what is happening just in the marketplace itself. And the key is you want to show that you're meeting milestones and your business is on track, and we're not trying to compare every single number to every part of the forecast, because there'll be some months in which you will miss those key numbers, and that's not really the point. We're at a little bit higher level here in talking about the good things that are happening in your business, and trying to get information across that we are moving in the right direction. When you do these updates, you want to make sure you customize the emails so they address the investor directly. Oftentimes what most entrepreneurs do is they take the investor prospects and they throw them on the PR list or the customer list or the general list, and the investor gets the same information that everyone else gets. And this is really not a good idea. What you really want to do is create a separate list, have a separate communication, and when you email out to the investor, you call them out by first name or their direct name without just saying, "Dear investor." You want to say John, Frank, Mary, whoever, and get very specific. And if you just put them on the PR list, it shows that you consider the investor to be at the same level as a customer or a media contact, and they really aren't, and they really don't want to be considered at that level. They want to be considered at a different level where they are, so your communications need to reflect that. And it shows that they are in the investor class and that you prize or you respect that class in a great deal more. And so your goal should be that every month you should add at least 10 more investor names to your investor prospect list. As you're meeting people and asking for potential investors, as you pitch investors, you're putting them on the list, and of course you always want to ask permission to email people so they know why they're getting the message and so forth. If you're sending out the updates and the investor has never heard your pitch and doesn't really know who you are, that may or may not go well for you. You really want to go pitch them first, tell them what you're doing, and then ask for permission, and then we put them on the list as well. So after about 6 months, if you're doing 10 a month, you'll have 60 investors following your progress. As long as those emails are short and to the point, most investors or many investors will open them up and read them because they're curious as to how it's going. Now, if they open up the email and they see a 500-word block of text, chances are very poor that they will read it. So it's got to be short 2-3 paragraph emails, 20-30 words each, and that's about as much time as we're going to get from people. And what you want to do is prioritize the investors who respond to the emails with additional questions and interests. Oftentimes investors will hit the reply button and ask a particular question or want to say congratulations on the movement or what have you, and you pull those investors out and you put them at the top of the list. They continue to get the same emails as everyone else, but what's happening now is we're bubbling up to the top 10 or 15% of those who are watching your deal and are interested. And those who are expressing interest in your deal, we start to set up follow-up meetings to give them even more information, and again to ask for funding as well. So if somebody's following along, asking you questions, then it's worth saying, well, let's get into a coffee shop next week and let me give you the full story of what we're doing, and you continue to build a relationship with those who are the most interested. Also at this point, what we're doing is we're looking for our lead investor, and what you're trying to do is find one person or one investor who will be the first to put the money in the deal. I often have entrepreneurs who will come back to me after about a month or 2 months of fundraising, and they'll say, I've got 5 investors who want to invest in my deal, but no one wants to lead it. And you can very quickly get into a place where everyone is stalemated because there's interest but not enough for anybody to sign the check. The investors start looking at each other saying you go first, no, you go first, and because there's not a consensus, it stalls out. And so what you want to do is get proactive as you go through the investor prospecting process and look for the person who might be your lead investor, and then we start to incentivize them to do that. So on average, of the 60 people or however many you put on your investor prospect list, 10% are going to come back after about 2 or 3 months and start to express interest to learn more about your deal and get serious about the terms and so forth. It won't be all of them. It'll be a minority of them, and you never quite know where it's going to come from, which is why you want to put everybody on a list and keep everyone updated as you go forward. It's more efficient as well if you keep it on an email system that you put out there. They say it takes about 7 touches to close a sale, so it takes 7 touches to close an investor. And after the pitch meeting, you're looking for multiple touch points in order to get to that magic number of 7, so they understand enough about your deal that they'll actually take a decision as to putting money in. Most entrepreneurs are looking for positive feedback the day after the pitch event, and they're rarely getting it because most investors don't have enough information, haven't thought it through, or have come to any conclusions after one day, and so they're not giving you any response. That does not mean they're not interested. It just means they haven't figured it out yet. They don't have enough information, and it's your job as the entrepreneur to go and give them that information so that they can make an informed decision. And in the end, it's like sales. Only 10% of all leads turn into customers, so only 10% of all investor prospects are going to turn into investors, and that's when things are going very well. So let's stop for a moment and let's take your questions and see what questions you have so far about that process. I call that the investor relations process, and it's in many ways it's a standard process that bigger companies use, but I've also noticed that those who are successful in raising funding, they're doing some form of that follow-up in order to get the funding or the fundraise closed. They're going back and updating and building a relationship before they make a decision that the investor wants to do so or not. So what questions do you guys have so far? And we'll go and see what we can do to answer those. So the first question is where do I find 60 investors. Well, the first thing you do is you go through your network. You go through your Rolodex and you find accredited investors. And as we said in the previous session, an accredited investor is an individual with a net worth of $1 million or more, not counting their house. And so you want to go through, and you'll find that there are many people in your Rolodex who are accredited investors, even though they may not be active investors. And so you want to open the discussion. Are they interested? Can you share your exec summary with them? Someone once said, if you want money, ask for advice. If you want advice, ask for money. And I find savvy entrepreneurs do this quite a bit. They go to prospective investors, and instead of asking for money straight up, they ask for some coaching or some advice, and it takes their guard down a little bit because they're not under pressure to invest right away. And so by asking for advice, you can start to get people associated with your deal, get them educated on what you're doing at some level, and then you can follow up by saying, may I keep you informed of our progress, and keep asking for their advice going forward. I find experienced entrepreneurs are very grateful for the investor's time. They're very thankful for it. They use those words. Oh, I appreciate your spending time. You're so gracious with your advice and coaching, and I'll certainly follow that up. And they make the investor feel rewarded for the time that they've spent with the entrepreneur. So if you have any more questions, go ahead and type them into the box, and let's move forward with the next module. And we're still on track here. So understanding the deal from the investor's perspective. And so what we're going to talk about is the case where, the entrepreneur and the investor are both looking at the same deal, but yet they come up with radically different views. And so what you'll find is, and I often have entrepreneurs coming back not understanding why the investor is not seeing the opportunity that they see in this deal. Why are they having so many questions or problems with moving forward with it? And the reason is that the entrepreneur is looking at the opportunity in the deal, and they've got customers asking for the product. They see the revenue that could be on the table there. They see the market growing. They see competitors out there moving forward very rapidly, so they know it's there. And it just convinces them that they've got the right answer. And it just seems like a great opportunity. And they're trying to communicate this to the investor. Yet the investor comes and looks at the same deal, but what they're going to look at is not the opportunity in the deal, but they're going to look at the risk in the deal. And what if the team doesn't work well together is a risk. What if the sales forecast isn't met? What if the customer is not happy with the product? What if the price point is wrong? And what if the competition is stronger than we thought? And so they're looking at the same deal as the entrepreneur, but what they're seeing is the risk of failure as opposed to the opportunity for success. And so what do you do as an entrepreneur when you're confronted with this where we don't seem like we're connecting like we want? Well, first of all, as an entrepreneur, examine the risk at each point in your pitch, and then go back and show the investor, either in a follow-up meeting or in the upfront pitch, show how you've mitigated that risk. And so, for example, what if the team doesn't work well together? What if that's a potential risk an investor talks to you about or expresses concern? What you do is you demonstrate how the team has worked well already. And sometimes you can preempt some of these things by putting these into your pitch as well. What if the sales forecast isn't met? Show your track record for how you are consistently meeting forecasts anyway in the past, and show that you've got a good system for forecasting and is working well for these many quarters. Maybe the risk is, what if the customer is not happy with the product? Well, there again, show how many customers are already happy with the product and what they like about it and so forth. So what you're doing is you're taking these risks off the table by showcasing how you've got the solution for it. So that went by pretty quick, but let's see what questions you have there as well. It's often the case that entrepreneurs are wanting to communicate all the great things in their business to have the investors see it the way they see it. And to be candid, I don't think the investor will always see it exactly as the entrepreneur does. I think there will always be some skepticism, some pessimism, and so forth in it, and they will always be looking to understand or understand how the risks are going to be taken care of. And so I guess the point of this presentation is don't be surprised if the investor is coming away with a different take than what the entrepreneur has. So let's see what questions you have at this point and see if there's anything we can share with you on that front. So the first question is how do you know if the investor has a concern? I think that's a good question. Sometimes investors are slow to ask real questions. They sometimes ask roundabout questions, or they come up with excuses for not wanting to dig in further. They'll sit there in silence. And so one of the things I always do is I ask investors directly, what are the risks you see in this business? And then see if they will articulate what they consider to be the concerns. And if you can get their concerns out on the table, you can then start to deal with them. If you don't get them on the table, it can be difficult to figure out how to go forward because you don't quite know what they're thinking. And what you may think is a concern is not a concern for them as well. One of the challenges with short 10-minute, 15-minute pitches like we're often doing is that it's really not possible to tell them everything about the business. You're really only giving them highlights, but in giving them highlights and doing so, you're simply putting out, you're causing some concerns to come up in their mind because they don't have all of the information that they need. What if they have a concern about the management team? Well, I think most every investor is looking at the management team very carefully, trying to understand if the management team really has everything needed in order to run the business. And again, the pitches doesn't often communicate all the abilities of the management team as well. So one thing you can do in a follow-up meeting is to invite the investor out and introduce them to the team and have the team talk a little bit about what they've done in the past, what they're doing on the project now, what they're bringing to it. And oftentimes that gives them confidence when they meet the team and they see the high-level team. You know, this is a strong team. They know what they're doing. They've been there, and because they met with them, they feel like they have a little bit of comfort level with the group as well. Again, as you're building a relationship between your company and the investor, you want to have as many touch points as possible, so it's always good to invite them out to meet yourself, meet the team, meet key customers, what have you, in order that they get to understand the business. And after a while, a little bit of your enthusiasm will rub off on the investor as they get into it. They'll be skeptical at first, but they will. So anyway, that's what we have on the second module. I had a couple of guys coming in just now, but don't worry, I will be sending the recording and the slides here at the end of the evening. You can catch up. And so let's move on to the next module that we have, and we'll talk about just to conclude that last module, the entrepreneur is seeing the possibilities, the investor is seeing the risk and the challenges. In order to raise funding, you have to go show how those risks are going to be taken off the table. So you can always try the technique of answering the investor's objections before they ask. So next one is how to set a valuation for your startup. And I kind of went through the last module a little bit more quickly because I wanted to spend a little bit more time on this one if we can. And so valuation is how much of the company you're giving up in order to take on the funding if you're offering equity. So what is valuation? So it's when you're raising funding and you're offering equity or ownership in the company, you have to set a value of the company before the money goes in order to know how much you're going to give for the money being raised. So the ownership is called equity, and how much do they get is the question on the table. And what you'll find is for equity-based measures, the traditional valuation doesn't really work. For later stage companies that have a regular book of business. They've got contracts with clients. They've got ongoing cash flow. There are traditional methods such as discounted cash flows, book values, asset values, but they don't typically apply very well to early stage companies where there may be some sales but not enough to really measure, and then there may be some assets, but again, it's not really capturing the value that is in your business. And so without significant cash flow and assets, what do you value in the business? And your real value is in the intellectual property, the team, the product, the business model. It's on these elements that you want to base it, and most traditional valuation methods don't do it. So the way you set a value for your company is you use what we call the rule of 4. And so what you do is for every one of the following, you want to give yourself a $1 million pre-money valuation for each of these things if you have it fully implemented and everything is there in that area. And we'll talk about that here in a minute. But the 4 that you want to look at is the management team, the product, the customers, and intellectual property. And so what we're going to be doing is if you have hired and placed everybody on the management team you want, everyone has substantial industry experience, 10, 15, 20 years plus, then you want to give yourself a valuation for $1 million for the team portion of it. If you don't have all the people hired, maybe you have half of them hired, well, maybe you give yourself $500,000 valuation for that portion of it. It is a little bit of a negotiation that you will have with the investor over valuation. Evaluation is always what you end up negotiating, not what you set as a formula. But what we're doing in this process is giving you the talking points to demonstrate how you arrived at your pre-money valuation. No matter what number you put on the table, investors will push back and ask, how did you arrive at that? And what most entrepreneurs do is they talk in very high-level, general terms about what they think it's worth or what they feel it's worth. But what you really want to do is go back to this methodology or this model and show the value that's in each of these areas and how you arrived at that. And of course there may be some negotiations, but at least there's something on the table that we can all look at. The other aspect of it is the investor may not understand all of the values you have in your business, and that's what you're doing in this valuation is you're identifying the values and you're putting that on the table to make clear what is there. You know your business better than the investor does, and so you are in the best spot to actually outline what those values are. So the next element after management team is the product. So again, you'll get $1 million if everything is here. So if the product is complete, it's shipping, all the bugs are worked out, everything's working the way you expect it to do, then give yourself $1 million for that valuation. But on the other hand, if your product is not fully featured as you intend and it's got still some bugs to work out, it may be in beta or version 1 early stage, then you may want to give yourself a lesser valuation for the product, maybe $300,000 or $400,000 for having the product there as well. Or in this case, if it's beta and requires more work, you give yourself $500,000 for that portion. Continuing on in our methodology here, let's look at the customer. If you have 10 large-scale customers and they're buying your product either on a recurring revenue basis or they're repeat customers that are buying it over and over again, then you get $1 million valuation. On the other hand, if you have a handful of small companies and some are in the try and buy phase and some have bought once and they may or may not buy again, you may give yourself a lesser than $1 million valuation because you don't have a full revenue stream turned on with repeat customers yet. And so maybe you give yourself, in this case, a $250,000 valuation. And the fourth one is intellectual property, same model as before. If all the patents are filed and everything's awarded and you have the full IP protection around your business with copyrights, patents, trademarks, etc., then you get $1 million. If, on the other hand, you have, for example, filed a provisional patent, but you've not received any office actions, they're not giving any indication it's going to go or not, well, maybe you give yourself less than $1 million. Oftentimes, we're at the provisional patent level. I'm advising groups to give themselves $200,000 for that patent as a pre-money valuation. What you then do is you add up all four of those numbers and use that as a starting point for a discussion with the investor itself. No matter what number you place on the table, the investor is going to challenge it and want to negotiate it, and so come prepared to negotiate and demonstrate how you arrived at your valuation. If you notice, the highest pre-money valuation you can get in this method is $4 million. And for early stage companies that aren't using traditional valuation methods, $4 million is a pretty good valuation. It's pretty high in many cases, and most companies, after they go through this process, are really in the $1 to $2 million range is where most people come out after you get down to where exactly you are with the team, the product, the customer, and the IP. And that puts you in the right ballpark with where angel investors are. Many angel groups, if you show up with a pre-money valuation greater than $5 million, you're going to have a hard time getting their interest. They, in some groups, actually put a rule that if you have more than a $5 million pre-money, you really don't need to submit because they're not going to consider it. So you need to understand a little bit about the investors you're talking to, and if you're going to formal groups, what rules they have around pre-money valuations and where they are with it. And also recognize at the end you need to be open to negotiate with them because it's just part of the process of raising funding, of meeting in the middle with investors. But here we're trying to arm you with some techniques for how you might want to figure out where your valuation may be in the discussion. The other point is to consider is what's called revenue-based funding. And we're seeing a lot of interest in investors wanting to put in money and take a piece of the revenue instead of or in addition to equity. If you go into revenue-based funding, what you're doing is peeling off 3 to 8%, 5% is a good average number. You're peeling that off every month and dividending the money back to the investor towards a preset or predefined payout. So they've got a 2x, 3x, 4x, or 5x return they're going to get over the life of this project, and you're simply dividending back as your revenues allow you and if your business model allows you. So we always encourage entrepreneurs to sit down with their financial team, run the numbers, and see if you can actually do revenue-based funding. If you do, you don't have to go through this valuation exercise that we just did because investors in revenue-based funding are not attaching to equity. And the entrepreneur does not have to give up any ownership. They're just simply giving up a portion of the revenue stream going forward. And there are many investors that are very excited about that because the time to exit on many equity deals has turned out to be rather lengthy. It used to be deals started and stopped in 5-7 years. Today, most companies start to stop is about 12 years, and that's quite some time for investors to be in a deal, and they're always looking to get more of their money back sooner and then getting a decent return out of it as well. So going to finish up on the valuation question, what you'll find is that the investor is motivated to have the valuation as low as possible so their money buys as much equity as they can, while the entrepreneur is trying to push it up to be as high as possible so they don't have to give away as much of the company. And so that's why it's a negotiation at the end of the day, is that there's competing interests. There's some haggling that will go on over it, and you want to come prepared for that as well. So let's go and open up and see what questions people have on either equity-based or revenue-based funding. First question is, what if I use a convertible note for it? How does that impact the valuation question? Well, that also, like revenue-based funding, it delays the valuation question because a convertible note says that the owner has a debt instrument that will convert to equity later. Typically when a Series A equity round of investments raised, the convertible note will convert at that rate or some discount to that rate and then you don't have to have that valuation question today. We're delaying the discussion of valuation till later. And if there is no equity or Series A fundraise, well, then there's something in the term sheet that will determine how that's going to convert into equity at some point. There'll be some fixed rate that will go into it. Having said that, you won't find many investors that are interested in convertible notes. So if you're trying to raise $500,000, $1 million, or $2 million on a convertible note, you'll find that to be somewhat challenged because most investors want equity or revenue. They don't want a conversion later because the conversion is out of their control. It will happen later at someone else's valuation, and that may or may not be what they were thinking when they entered the deal as well. Next question is the revenue-based funding a loan? It's like a loan, but it's not technically a loan. The investor is not getting a personal guarantee. They're not getting collateral. They're not getting assets. In revenue-based funding, about the only thing the investor attaches to is the intellectual property and the accounts receivables, and after that is simply a risk, which is why investors are wanting 3x their money in 3 years, or 4x their money in 4 years, or 5x their money in 5 years. They want multiples because there is a risk in revenue-based funding. The business could go away next week, and they would have nothing. They would have no future revenue stream. So there is a risk in there, and so the reward has to be commensurate with that risk, which is why 20% return, 30% return simply doesn't cut it. And in the debt financing world, where they have personal guarantees and attach the house, they have fixed payments, and they're going to get those payments no matter what. And if you default, they take your house or your car or whatever assets you collateralize with it, and that's how their business model works. So revenue-based funding is halfway between equity and debt, and is a very popular way. To get revenue-based funding, you must have existing sales. You must have a clear growth path. If you have no revenue, you're going to find it very hard to engage in revenue-based funding because nobody knows where you're going to be able to start and if you can continue the growth with that there as well. Any other questions you have before we move on? Okay, let's move to the next, or the fourth session we have today. And so, working with angel investors. And I get this question a lot. Most entrepreneurs, especially first-time entrepreneurs, have never dealt with angel investors, and they don't really know what to expect. And so, what I always tell prospective entrepreneurs is that angel investors are, come in all forms, shapes, sizes, and types. Their investment criteria varies dramatically at what they look for, what they put money into, what do they can perceive as risk. Their contribution to your business varies dramatically as well. Some have a rich Rolodex, some have deep pockets for funding, some have a great network, some have skills, some know strategic partners. You never know exactly what they can do until you talk to them, and so you want to keep an open mind about it. Also, what you'll find is their motivation to invest varies quite a bit as well. It's true most want a return. Someone once said an angel investor is someone who wants to do a little good, have a little fun, and make a little money. And you may want to keep that in mind, is that it's just not all financial or professional. There is a give back portion to this, and there is a desire to promote and help the community at some level, and so they want to do a little good. And they're typically doing this as a sideline from their day job. Very few people do angel investing as a full-time job. There are people who run family offices, families with a large amount of money. Sometimes they have a full-time day job looking at deals, vetting them, investing in them, and so forth. But most angel investors are not in that category, and so what you'll find is angel investors are doing this on the side, and some treat it as a hobby, some treat it as a very professional exercise, and others do not, and there's everyone in between. So you're going to meet a lot of different people out there. The other thing you'll notice is that some angel investors are very experienced in the fundraising process, but I would say most are not. It will be often the case an investor comes to you and says, I want to invest, now what? And they don't really know what the next step is. And you may have to guide them through the process and make sure that they know how to do this, especially if it's the first time they've ever invested. And that's always a good question to ask. Have you ever invested in a startup before? Have you ever invested in a venture fund, or do you know anybody that does this already, just to gauge their skill level and their knowledge level? And you'll often find people that have zero skill or experience having done this. They really have no idea what the next step is and how to go forward with it. So one of the questions you need to ask prospective investors, especially those who are now expressing interest, is you need to make sure they meet the accredited investor criteria. And for those who are going to family and friends, and while that's a valid way to go, it's often the case that family and friends are not accredited investors, and you have to figure out how to make that work. But the key is you want to make sure that if they are a standard investor, they have a net worth of $1 million excluding their home. And if you want to see the exact requirements or definition, and there's about 10 different ways you can become an accredited investor. You could be running a fund, you could be running a family office, you could have income of $250,000 a year for 2 years running. There's a number of other ways to achieve accredited investor status. You can go to the Securities and Exchange Commission. They have a website that has the full description on it, and you can get more details there. As you're dealing with investors and going through the process of closing the deal, what you're going to find is that most angels are not experts in your industry, and you'll quickly discover that by the questions they're asking. And so part of what you have to do is educate the angel about your industry, not just about your company, but also about the industry, the competition, the landscape, the dynamics, what's working, what's not working, how do things work in this industry. And that's one of the things you can do with your email updates to the prospective, your investor prospect list that we talked about in the last module, is that you can put a few nuggets of information in there to help educate them on your industry as well. And so you'll need to educate them about how the market segment works and so forth. The other thing you find about angels is while there's some lead investors out there, and there will be people that will take charge, most will not. And so you will find yourself herding the cats. And angel investors, everyone's investing their own money in their own way in most cases. They all have their own agenda. They're investing for their own reasons. They've got their own time commitment that they're going to put in or not put in, and so you're dealing with a wide range of discussions. And so one thing I found that can be very helpful is to structure the follow-up to help guide or herd the cats. I once had an entrepreneur that had 10 investors in the room, and each investor was negotiating their own terms. And they weren't working with each other. They were just trying to cut their own deal with the entrepreneur. And there's no way you're going to be able to manage 10 different negotiations. So what the entrepreneur did was he told the investors, you guys aren't ready yet to have this discussion. I'm going to leave the room for 1 hour and go across the street to the Starbucks and have a coffee. And in that time, I want you 10 guys to come together and come up with one negotiation. He had them all in the room, and he said, I want you guys to work on what your terms are going to be, what you're offering, what you want it to be, and put that together, and I'll come back in 1 hour. And he did. He left. He came back, and the investors wrote on the whiteboard what the terms were, what pre-money they wanted to have for it, how much they were going to put in. And he was able to negotiate going forward because he got the investors to come together and agree among themselves as to what they wanted to do. And you're going to have to do things that herd those cats. For example, organizing synchronized follow-up meetings. For example, you can invite everyone that you meet for a week to come to the same meeting. When you're pitching in a session, you can say to the audience, okay, a week from today at 10 o'clock in our office, we're going to have the follow-up meeting. We'd love to see you there. We'll serve lunch afterwards. Everybody come at 10 o'clock to our meeting next week. and you'll get not everybody, but you get most people coming out, and instead of having 10 different meetings, you'll have fewer meetings, and you can organize the follow-up to reduce the number of meetings and the amount of time you're spending with investors. And then investors can see each other, and in many cases that's a positive thing, because the reason many investors don't want to be the lead is that they're not clear on who else is in the deal. Are they going to be the only one? And if you have 5, 10 investors coming out to see a follow-up meeting, that gives them comfort to know that there are other people in the deal that will be helping the process along, and each investor won't be the only one in the room as well. As we said in the last session, as we're doing the investor prospects, we're looking for the lead investor. And so one of the first steps we're going to be doing at this stage is to find that lead investor. And for those who are not familiar, the lead is the first one to invest. And what you want to do is find somebody that will be the lead to put the first money in on what we call investor-friendly terms, or signing up a contract that will be interesting to other investors. And so what you want to do is get the lead investor to put together their due diligence, and you want to capture that due diligence into a packet of information. Yes, you may have a checklist and you've got all the docs that you have. The lead investor will have another checklist that requires other documents, but what you want to do is capture all of that into one place, and then after the lead investor signs up the funding, you go to other people and say, well, our lead investor is in, here's the due diligence that they did, and you offer that as a box straight up front. And many, if not most, investors will take that as the core of their due diligence. They may ask other questions or ask for additional documents, but you will be covering probably 90% of what they want to do. So by making that available to follow-on investors, you now make it easier to get other people into the deal. And after you sign up the lead investors, others follow very quickly. And if your lead investor has some name recognition as being a proficient investor or a community leader, that helps your cause dramatically. So one of the things you're looking for in a lead investor is somebody with experience and somebody with a name. And so what you're often find with lead investors is that you are going to have to incentivize those lead investors. And if you've got 5 people that want to invest but nobody wants to go first, you choose the one you think would be the best lead investor, and you go to them and say, well, if you'll do the additional work and go first, I'll give you a little bit better deal than anyone else. And by that I mean we'll give you extra warrants, stock options, stock grants, compensated board position. We'll do something to compensate you for it. One reason why angel groups and others do not want to lead deals is that it is often positioned as 40 hours of additional work without compensation. And you have to recognize that as an entrepreneur, that you're asking somebody to do 40 hours of work for free, only to see other investors come in, write the same check, and get the same equity ownership, but they didn't have to put any time into it. Many investors don't do lead work for that very reason. Other people are riding off of their work, and they don't like that. And so what you have to do is make clear that the work they are putting in and the risk they are taking by going first, because they could be the only one, is going to be compensated by additional grants, options, or something that will make it worth their while. So as you start to find you need a lead investor, you realize you will have to compensate that person to be a lead investor, and it will be worth it, because the first one is the hardest one. After that, it gets exponentially easier as more and more investors sign on, because they're seeing that the risk of it not getting funded starts to go away as more and more people sign up. So in summary of this module, you'll need to educate the angel investor about your space and about your industry in addition to your deal as well. And there are ways to reduce the follow-up process to make it more efficient with common meetings, having investors talk to each other, having them work on coming to a consensual agreement. And as you'll go through this process, you need to find a lead investor and identify and compensate them to lead it going forward. So that's it for this module. What questions do you guys have at this time? Okay, so where do you find lead investors? Well, typically you find them in your investor prospect list. As investors are coming in and as they're responding to your email updates, you're going to find some people more interested than others. You're going to find people who are excited about it. They know a lot about the space. They want to invest, or they've got the pockets to invest, and so you want to identify them from the investor prospects. It's possible you can go out there and choose a well-known investor and see if they will lead your deal, and that's also a possibility. But the first thing to do is to go to your prospect list and monitor the responses you're getting out of the process going forward. Next question is, do angel investors get tax credits? Well, in some parts of the country, they get tax credits, and those are typically state income tax credits, because here in Texas we have no state income. Those tax credit policies usually don't move the needle much because Texas investors aren't paying state income tax. As they move that discussion to a federal level and they're offering federal income tax breaks, it gets to be much more interesting, but I haven't seen that discussion in some while, so I don't think that's going to happen anytime soon. So in short, tax incentives really aren't a factor for the investor at this point. How do you find a lead investor for a revenue-based funding deal? Well, if the investor is interested in revenue-based funding, there are many websites and many resources out there that can coach them into how to do that. If they're an experienced investor in this area, then they probably already know how to do revenue-based funding. And so if you want to go after revenue-based funding, we can always point you to people that are already interested. But one of the best things to do is float the topic with all investors. What kind of deal structure would you like? It's often the case the entrepreneur wants to come with a complete story, and while it's good to have thought through the equity raise or the convertible note raise or the revenue-based raise, it can be a collaborative effort to come up with the final deal structure for it as well. How do you educate your investor on a technical topic? Okay. Well, you know, one thing I find with investors is that they're only going to go so far into the technical details before they're going to say that's good enough. And so you don't have to turn them into a scientist or an engineer in order to invest in your deal. What I often find is the case is that while some want to know how it works, most are happy to know or just take away the benefits of what the product does. So one approach to this is to say our product reduces cost by 30%. Our product speeds up time to market by 5x. Our product improves ROI for the customer by 200%. These are the kind of benefits that they really want to hear about, and maybe they want to know exactly how the software works or how the technology is playing out, but that usually takes many meetings, many white papers, education sessions, videos, etc., for those who want to know about it to get there. So start with the benefits of what you do and then move forward until the investor is excited enough to go ahead and write the check. And that's a good point about that also applies to due diligence. Someone once asked, how much due diligence is enough? Well, the answer is you do due diligence until the investor writes the check or decides they are not going to write the check. There is no set time frame. There is no set hours. There is no set checklist. Those things checklists are very helpful and they're good guidance tools, but every investor is different and every deal is different, and so there's no one size fits all. What other questions do you guys have? I think that's it for what we have here so far. If you have any questions, go ahead and type them in, and we'll try to answer those here. And then what we'll do is, as we said before, we'll record the session and send it to you with the slides later tonight. I know a few people jumped on a little bit late. That's okay. We'll get to that in the next. You'll see that in the session I send you this evening. So with that, let's go ahead and close out for this afternoon. We've got about 7 minutes left. So by all means, thank you guys for joining us today for this module. And we'll have one more session next week. If you would like to talk more about your deal, by all means reply back to the email I send you this evening with the slides, and let's set up a time to talk by phone or in the coffee shop. I'm always happy to answer your specific questions and talk about your deal, and then coach you on any questions that we don't cover in these slides around fundraising. And it can be venture capital, it can be crowdfunding, it can be bank debt, it can be whatever you might want to look at, and we'll give you some coaching on that process. So with that, I don't see any more questions. Thank you guys. Have a good weekend, and we'll see you guys next week. Thanks.